Welcome. In this video, ZBCN coin pump or dump, we will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
When we carefully examine the chart, we can clearly observe that the price has been moving under downward pressure for quite some time, forming a descending trend line in the process. This descending trend is typically drawn by connecting the peak points and is recognized as a technical formation where the price continuously makes lower highs. Such formations indicate that selling pressure dominates the market and that investors are increasingly inclined to sell at lower levels. However, not every downtrend lasts forever. Over time, this pressure can weaken, and significant changes can occur in market dynamics. In the current chart under review, the descending curve serves as an important resistance level that investors are closely monitoring. This descending trend line is considered a key reference point by both technical traders and algorithmic systems. Every time the price approaches this line, it may once again face selling pressure, just as it has in the past. However, this time there seems to be a shift in the underlying technical dynamics. The price is approaching the descending trend line with much more determination and strength. Especially when examined in lower time frames, we can observe increases in volume, upward divergences in momentum indicators, and positive divergences in oscillators like the RSI. All these signals suggest that the descending trend line is getting ready to be broken, and that a bullish sentiment is starting to form in the market. If the price manages to break above this descending curve, or resistance line, it would be a highly positive breakout from a technical perspective. This type of breakout indicates that the psychological pressure in the market has been lifted and that investors are beginning to take bullish positions. Particularly in scenarios where the downtrend has persisted for a long time, such breakouts can turn into very strong rallies. This is because the breakout signifies not only the passing of a technical level, but also a complete shift in market psychology. Sellers are replaced by buyers, fear turns into hope, and investors may move toward aggressive buying with expectations of higher prices. In such a scenario, if the price moves above the descending curve, a sharp upward move can be expected. The first target of this movement is typically the previous major high. However, in many cases, the price may surpass these points and move toward even higher resistance levels. When a descending trend is broken, technical traders often have stop-loss orders set to trigger upward, leading to sudden and high-volume buying in these areas. This can cause the price to quickly surge in a short amount of time. Moreover, such breakouts attract the attention of other investor groups. In particular, institutional investors and large whales may enter the market once technically significant levels are broken. For the uptrend to continue in a healthy way, it is very important for the price to retest the descending trend line as support after the breakout. This is called a throwback and is generally considered a reliable confirmation of a bullish trend in technical analysis. If the price returns to this line after the breakout and continues upward after finding support there, it suggests that the rise is not just a temporary move, but the beginning of a bigger and more sustainable trend reversal. In this case, strong signals would indicate that a new uptrend has started in the market. From a psychological perspective, the breaking of a descending trend is also very significant for investors. A price that has been moving under a downward trend for a long time creates pessimism among investors. Every attempt at a rally is suppressed by a new wave of decline, causing investors to lose hope each time. But all it takes to break the psychological pressure is for the descending trend line to be breached. This breakout dramatically changes the mood of the market. Investors who previously sold at every peak now start to view those levels as buying opportunities. This makes it easier for the price to climb to higher levels. In addition, volume analysis is important for testing the strength of the breakout. If there is a significant increase in volume as the price breaks the descending curve, it is considered a real and sustainable breakout. Breakouts without volume are often called fakeouts and can be deceptive moves. However, if the current chart shows increasing trading volume at the breakout point, it suggests that this rise is built on a strong foundation. Volume-backed breakouts are commonly seen at the beginning of new trends. In light of all these technical and psychological analyses, if the price moves above the descending trend line, not only a short-term rally but also the beginning of a long-term uptrend becomes possible, especially if this rise is supported by other technical tools such as pattern targets, Fibonacci levels, and moving averages. A much clearer and more reliable buying opportunity may arise for investors. In conclusion, the upward breakout of the descending curve or resistance line on the chart is not merely the breaking of a line. This event carries much deeper meanings in technical analysis. It is a significant signal that the market direction has changed and that buyers have taken control, and that investors are now increasing their bullish expectations. The rally that results from such a breakout is supported not only by technical data, but also by psychological shifts. This means that all the dynamics required for the price to enter a new and strong bull market are coming together. But we can't make a decision based on the curve. Let's take a look at other metrics too. Keep watching.
One of the most effective tools used to better understand price movements in the market and to anticipate potential reversal zones is undoubtedly Fibonacci retracement levels. These levels help investors estimate where the price might encounter support or resistance and make market behavior much more predictable. Especially after a strong uptrend, Fibonacci retracement levels act like a roadmap during pullbacks. In this context, the Fibonacci tool is applied to the chart by taking into account the price movement from the lowest to the highest point. Among the retracement levels obtained this way, the most notable ones are undoubtedly the 0.618 and 0.786 levels. The 0.618 level of Fibonacci, known as the golden ratio, is a universal mathematical relationship frequently encountered not only in financial markets, but also in nature, art, and science. The reason this level is considered so important in technical analysis is that the price often pulls back to this zone and then resumes its upward direction. This level is typically seen as a critical point where investors believe the price has become cheap and begin to consider taking long positions. It is often considered the first major support and is especially important for investors expecting the trend to continue. The 0.618 level is often the market's breathing zone. In other words, the price has reached a critical point where it may pause briefly before resuming its upward move. However, in some cases, this initial support level may not provide a sufficient reaction, or the market may face further profit-taking. This is where the deeper retracement level of 0.786 comes into play. This level is a very critical area that often misleads investors into thinking the uptrend is over, only to reverse direction. While many investors interpret a pullback to the 0.786 level as a sign that the trend has ended, this level can actually signal that the trend is still intact, but this is the final buying opportunity. As a result, institutional investors and large funds often prefer to open positions from this level. Investors who buy at this level typically have lower risk and higher potential returns. In our current analysis, the Fibonacci tool applied from the bottom to the top provides us with two very clear critical levels, 0.618 and 0.786. Upon examining the price movement, we observe a pullback approaching these levels. This is an extremely important technical signal, as the price is balancing the energy used to form the previous uptrend with a correction that is occurring precisely within the ideal buying zones of 0.618 to 0.786. This area is frequently referred to in the investment world as the golden pocket. The golden pocket is the region where investors expect the price to reverse upward again and where heavy buying often occurs. Positions taken from this zone can yield significant gains both in the short and long term. The fact that the price has reached this zone could indicate that the current downward move is simply a correction and that the overall trend may still be upward. Every trend experiences pullbacks, and these are part of a healthy market structure. If a market rises continuously without corrections, it can turn into an unsustainable bubble. Therefore, Fibonacci retracement should be viewed as healthy consolidation zones following uptrends. At this moment, the price finding support between the 0.618 and 0.786 levels suggests that this move is a classic correction and that a new upward wave could be starting. These zones are also critically important from a psychological standpoint. When the price reaches these levels, many investors see the area as an opportunity. Especially those who missed the initial rally may open positions thinking, here's another chance. This increases demand and causes the price to react upward. So these levels are not only technical, but also strategic psychological zones where the market can revive. If the price gives a strong reaction from these levels and starts moving upward, this situation will excite both short-term traders and long-term investors. In particular, an upward breakout from the 0.618 level is typically interpreted as a strong signal that the initial wave of the rally is about to restart. Positions taken at this point offer both low risk and high potential returns. If the rebound that starts from this level is supported by increasing volume, it may suggest not just a reaction, but the formation of a new trend. Although pullbacks to the Fibonacci 0.786 level may seem risky to some investors, this level is actually a highly attractive opportunity for patient investors seeking high returns. This level is often the deep support zone where the price bottoms out after irrational fears in the market and may begin a new upward trend. Therefore, if the price pulls back to the 0.786 level and reverses upward from there, this move could signal a strong and sustained rally.
When we closely examine the chart, a highly notable formation can be observed on one of the technical indicators, Bollinger Bands. This indicator is frequently used to analyze how prices move relative to volatility and to identify periods of contraction or expansion in the markets. Bollinger Bands are created by placing two standard deviation lines around a 20-period simple moving average, and the movements of price in or out of these bands generate highly significant signals in technical analysis. Under the current market conditions, a clear narrowing of the Bollinger Bands is observed. This contraction indicates that price movements are highly limited and range-bound, suggesting that the market has entered a calm before the storm phase. In technical analysis literature, this situation is often referred to as a volatility contraction. These formations are typically seen as precursors to very strong price movements. When the market remains compressed in a narrow range for an extended period, the built-up energy is usually released in a powerful breakout, causing price to make a directional surge. Narrowing Bollinger Bands actually indicate uncertainty in the market and that investors are in a wait-and-see mode. Both buyers and sellers tend to act more cautiously, and large capital generally prefers to observe rather than decisively move the market. However, based on past price movements, when Bollinger Bands contract to this extent, sharp and rapid price movements often follow. This situation is considered a very strong signal by many technical analysts, as the contraction may indicate a breakout, a trend reversal, or an acceleration in the existing trend. The fact that the bands have compressed to this degree shows that the price is about to choose a direction. In other words, the market is at a decision point. This decision could be upward or downward. However, our other technical indicators suggest that the likelihood of an upward move is stronger. During such periods of contraction, the most important element to pay attention to is sudden price moves toward one of the bands. If the price breaks out strongly toward the upper band and this move is supported by high volume, it usually signals the beginning of an uptrend. Prices moving above the upper band indicate that buyers are in control and that the move may continue. Especially breakouts to the upside from a narrow band point to strong momentum and typically lead to prices climbing rapidly to higher levels. For this reason, investors watch Bollinger Band contractions very closely in order to catch these breakouts. The Bollinger Bands may be about to explode soon.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.